Hello guys, welcome to i-tutor Academy. In today's session, we will start with Unit 2 of MMBC 004, that is preparation of books of accounts. We just mentioned books of account in Unit 1. So let's see the objectives. After going through this unit, you will be able to know the meaning and steps of accounting process, understand the meaning and importance of journal, and know the rules of journalizing. And the structure of these units are: introduction is there, analysis of business transaction. Under this, there is an overview of balance sheet, classification of accounts, dual aspect of account, and accounting equation approach. Okay, in this video we will finish this much 2.2 sessions. And next is journal is there, and journalizing and important consideration of recording the business transaction, and ledger also there, and summary self-assessment questions are there in this unit. And let's begin with the introduction part. A business enterprises generally prepare the following two basic financial statements, that is profit and loss account, to ascertain the profit earned or loss incurred during an accounting period, and balance sheet to ascertain the financial position of the business as on a particular date. Cash flow statement. Generally, a business enterprises has numerous transactions every day during an accounting period. Unless the transactions are recorded and analyzed, it is not possible to determine the impact of each transaction in the above two basic statements. Traditionally, accounting is a method of collecting, recording, classifying, summarizing, presenting, and interpreting financial data aspect of an economic activity. The series of business transactions occurring during the accounting period and its recordings referred to an accounting process or mechanism. An accounting process is a complete sequence of accounting procedures which are repeated in the same order during each accounting period. Accounting period process involves the following steps or stages. First one is identification of transaction. In accounting, only business transactions are recorded. A transaction is an event which can be expressed in terms of money and which brings change in the financial position of a business enterprises. An event is an incident or happening which may or may not bring any changes in the financial position of a business enterprises. Next is recording the transaction. Journal is the first book of original entry in which all transactions are recorded event wise and data wise, and present a historical record of all monetary transactions. It may further be divided into sub journals as well as, which are also known as subsidiary books. Accounting process. Here is a one chart, that is the accounting process. You just go through it. And the next is classifying. Accounting is the art of classifying business transaction. Classification means statement setting out for a period where all the similar transactions relating to a person, a thing, expense, or any other subject are grouped together under appropriate head of accounts. Next is summarizing. Summarizing is the art of making the activities of the business enterprises acts classified in the ledger for the use of management or other user groups. Sunday debtor and Sunday creditor, debtor and sundry creditor, etc. Summarization helps in the preparation of profit and loss account and balance sheet for a particular fiscal year. Next is analysis and interpretation. The financial information or data as recorded in the books of an account must further be analyzed and interpreted so to draw useful conclusion. This analysis accounting information will help the management to assess in the performance of business operation and forming future plans also. Presentation or reporting of financial information. The end users of accounting statement must be benefited from analysis and interpretation of data, as some of them are the stockholders and the other one the stakeholders. Comparison of past and present statement and reports, use of ratio and trend analysis are the different tools of analysis and interpretation. Next is analysis of business transaction. Accounting process starts with a business transaction and is followed by analysis of the transaction for the purpose of classification and recording of the transaction. Once the transaction is recorded, similar type of transaction are summarized and the net figure arrived it is taken to the financial statement. Voucher is there. Accounting is a process which starts and includes steps right from recording of business transaction of monetary character to the communicating or reporting the results thereof to the various interested parties. The first step in the accounting process is to analyze the transaction and record it on a pre-designed slip giving details of accounts to be debited and credited. Each transaction is recorded in books of accounts, providing all the required information of the transaction. Since each transaction has an effect on the financial position of the business, there should be a documentary evidence to establish the monetary accounts at which transactions are recorded and also the transactions are properly authorized. The common documents that are generally used areas under payment voucher is there. A payment voucher usually on a printed standard form of record of payment. Okay, and a receipt voucher is there. A receipt voucher is a document which is issued against a cash receipt. And a transfer voucher is there. A transfer voucher is used to record the residuary transaction. An internal transaction or a transaction not involving any cash payment or cash receipt is recorded in the transfer voucher. An overview of balance sheet. Let us understand the concept of a balance sheet with the help of an example. So you just go through this example. There is an example of balance sheet, and balance sheet preparation is here. One chart is there, liabilities are there under that, and amount asset is there, amount is there, right? So you just go through with the example. Thus the net worth of the entity represent the claim of its owners, which also referred to as owner's equity. We also learned that the item of monetary value possessed by an entity are referred to as asset, whereas the amount owned by the entity which represent claim against its asset by outsiders are called liabilities. Thus, we can say that the position statement is a summary of the asset, liabilities, and net worth of an entity at a specific point of time. Next is classification of accounts. Accounts are two types. One is personal account and one is impersonal account. Impersonal account also divided into two, real account and nominal account. Real account divided into tangible real account and intangible real account. Personal accounts are natural personal account, artificial personal account, representative personal account. Personal accounts, accounts which are related with the accounts of an individual fame companies are known as personal account. The personal accounts may further be classified into three are there: artificial personal account, representative personal accounts, and real accounts and nominal accounts. What is real accounts? Real accounts are the accounts related to asset and properties, and nominal accounts the accounts relating to income, expense, losses and gains are classified as nominal accounts. Examples are there. And rules for debit and credit. Type of account is there. Rules for credit debit is there. Rules for credit is there. Dual aspect concept. Let us take a step further in the previous example. Suppose Mr. Raghav, there is an example dual aspect concept. You just go through it. Asset is equal to liability plus owner's equity. Okay, and the above accounting equation indicate that the entity asset have to be equal to the sum of its liability and owner's equity. This equation is considered to be the foundation of double entry system of accounting. So next is accounting equation approach. This basic accounting equation is asset is equal to liability plus capital. In this equation, asset refers to the resources owned by the business enterprises. These resources are expected to generate future cash flow and earning for the business. Okay, when we use accounting equation approach for recording business transaction, all accounts are divided into three categories, namely asset account, liability account, capital account. And next is the capital account increases due to introduction of new capital, revenue and income earned. It decreases due to withdrawal of goods, cash and other assets for personal uses and expenses. So for recording the item of revenue and expenditure, temporary capital account are created. The reason behind calling these account as temporary capital account is that each of these accounts start with zero balance at the beginning of the accounting period and at the end of the accounting period. These accounts are closed and their balance are transferred to profit and loss account, and the net balance is transferred to capital account. The temporary capital accounts include revenue account, expense account, and drawing account. Okay, so that is the about the accounts. So here is an example and tables also. Analyze of business transaction, traditional approach, different approaches are there. You just go through it. You will get with your IGNOU study materials MMBC 004. Okay, and unit 2. Here is tables are there, so you just go through it, and if you have any doubt regarding these tables and all, you just contact our contact number also, otherwise you can comment it on our comment box also. So next section of unit 2 we will cover on next video. If you like this video, you just like, and you need more videos, and you just subscribe and share our channel. Thank you so much.
i-tutor ES presents IGNOU MBA, complete syllabus coverage classes and individual semester base, subject coverage program for MBA students online and flexible sessions. For more details, contact 62382 17885.